Okay, great. Welcome to video 3. So the titles of these videos, I know I've been calling them Throughput Accounting, and I only introduced the first 2 bits, sort of explain this question of contribution. If you've studied contribution before, you've always considered contribution to be selling price minus variable costs, and the variable costs you've always remembered and always sort of understood were direct materials and direct labor. So this has been strong association of the two as being variable costs. Throughput accounting sort of seeks to get modern. Again, like I said, that when I was discussing activity absorption costing and activity-based costing, I discussed this move away from your traditional labor accounting, where you're just looking at labor hours as your means of as your source or your driver of overheads, to a more automated view of looking at absorption, and therefore the overhead costs aren't really driven by labor anymore. They're pretty much being driven by, if you like, quality inspections, setup costs, delivery, consultancy in improving the value chain. So really, manufacturing has become modern, and in the process of manufacturing becoming modern, we're talking about things like just-in-time analysis. So we're keeping very little inventory. So really, the idea is that a lot of these things are becoming more automated, and we're using less and less labor. And because we want to be cleaner and neater, we're almost trying to eliminate a lot of the traditional costs we think of, even labor. So for 2 points with labor, we're moving away into automation, and 2, in reality, to a certain extent, in the short term, labor is rarely ever variable. Typically, people are on salaries. You have them at the end of the day. 0-hour contracts, I agree, exist, but they're frowned upon. So the only time you could argue that labor was truly variable was if you're dealing within a 0-hour contract realm, where everyone was in 0-hour contracts. But so that's the focus here. So throughput accounting moves in that direction. Very similar. Again, we're just saying in the short term that all costs are fixed with the exception of material costs. So the argument here is that the only variable cost is materials. This is key. Remember this. I'll say it over again. The only variable cost when we're looking at throughput accounting is materials. So we're really arguing that all the other costs are fixed. So as far as we're concerned, and the aim of this is to drive everyone to think of contribution, really, or if you like, throughput, which is what we're going to call it, as being based purely on the relationship between sales and your materials. I mean, with materials, to a certain extent, there's nothing you can do. It is variable. You want to make more, you need more. The argument with labor is once we get rid of people, well, there's no variability with it. So again, like I say, this is focusing really on materials. I've already discussed the fact that labor tends to be fixed. Labor is rarely variable anyway. In a just-in-time environment, our aim is not to hold any inventory. So, which is why, if you think about it, when you prepare a normal income statement, you sort of have sales minus cost of sales. We don't have, with just-in-time, we don't have, the whole idea is we don't want opening inventory, we don't want closing inventory, we purely want what we need for the day. And so again, the same idea is that even though there's a scenario, we can still have the same issues that we had in the earlier videos that I discussed, where we have some certain scarce resources. So throughput accounting is sort of saying, do exactly the same thing you just did previously, but this time, only use materials as your variable cost. So let's carry on. We'll use the first scenario to sort of explain. Oops, sorry, I'll just go back. Explain what I was sort of saying. Exactly the same scenario. Nothing's changed. Product X and product Y. But before I end, you can see here clearly. What am I telling you? I'm telling you here that this labor thing, this labor business over here, please now consider it as as a fixed cost. This labor, or the variable, fixed. These are all now fixed costs as far as throughput accounting is concerned. So what is throughput? Throughput is your sales revenue minus your direct material cost. And so what do I have here? That's your selling price. I hope you have the PowerPoints to look at, sort of flick back, and you can go back in the video to see what we have taken these figures from. So that's your selling price minus your materials, and that's your, I really shouldn't call this contribution. Forgive me, please. You could put a stroke here and call this your throughput. I mean, technically, in the definition of the term contributing towards profit, it is contribution, but so that you don't mix up the ideas. Earlier on, we talked about contribution really being selling price minus variable costs. Throughput is pretty much selling price minus materials. This is your throughput. I've deleted that. Good. So this next slide is quite clear. So selling price, materials, and then you have your throughput, 17 and 8. So again, this is really saying that, who should we make? Same scenario. Who should we make given the circumstances of scarcity? And again, it takes you 2 hours to make this and 1 hour to make this. So very much like the video one, we find throughput per hour, if you like. So really, this is the return per factory hour. So every hour spent narrates 8.5. I mean, the throughput is 17, but 17 divided by 2 is 8.5. 8 divided by 1 is 8. So in this scenario, product X now becomes the product that we first make, because we now consider labor to be a fixed cost. Remember, this is all very much in the short term. So the question here is we're trying to maximize our contribution. So we go through exactly the same process because we're with 8,000 for product Y. And remember, we're calculating throughput. So we have 20,000 units of X times 17. That's the throughput, isn't it? Giving you 340. And then you have 8,000 units at £8, giving you 64,000, giving you a total throughput of 404,000. Now, in the exam, your classic questions will tell you to calculate the throughput, and they'll give you the fixed costs. And then you just take the fixed costs away, and then you're able to find profit. Kind of like as normal, just that this time, labor is a fixed cost. In class, we'll do some more questions where we'll get to practice this. This is still theory, so for you to get the concepts going. But you might have a few, the examiner play around a bit and tell you, you might have to work out the labor separately, or he might give you labor and other variables. We just have to add them together. The key point is that we know that labor and other variables and other fixed costs are fixed costs, and the only variable cost is your material. Okay, great. So we'll end that video there, and then we will come back and look at a few other sort of ways of analyzing and playing with these figures. A couple of formulas, nothing crazy, but just help us to make meaning of these figures and use them to actually make decisions in the short term, typically in the short term, because throughput, all these ideas, the idea of contribution, again, I stress that, is very much a short-term decision-making tool. Okay, great stuff. See you in the next video.